What's going on, everybody? You are listening to the Co-Living Show. Miller tried to
I was
take over, but
I was like
I intercepted it straight.
like 10 seconds before that's like, all right, Craig, I'm gonna drive. And then I tried to swoop in. No shot. All right, maybe next episode, guys. I'm
No,
gonna butt in
no,
way.
just keep doing your nails
Yep.
over there in the passenger seat. Put on your makeup, look cute, and make sure you tell me which way to go directionally. Like about 2 minutes after I've passed the exit.
I see. Yes, I've encountered this in my life.
It sounds familiar, but you have a Tesla, so you don't need that.
Yeah, that is true. It happens actually. Okay, to be honest, so we have full self-driving in the Tesla. It's like super duper duper cool. I trust it all the time. 100% of the time, I don't care. My wife, though, if we're in the car, she is like more laser focused when it's in full self-driving than whenever I'm driving. So like, I get a lot more criticism. It's like, you got to turn it off. Don't let it turn that way. Don't let it do this. So it gets worse.
Okay, good to know. So I was already on my list to not get a Tesla, but I'm going to continue to put it up the list of things I don't want.
If you're
Anyway,
single, it's a great idea.
single. Okay, if you're single, or if you know what they need is like in the Tesla, they need like the passenger seat to be like a barber seat, how it like spins 360. So that way you can spin it around and lock it. So that way she's just looking out the back and that's
Totally.
it.
So you're actually not far off. They're launching it was at their event last year. I'm just a nerd about a lot of stuff, but they're launching I forget what they called it, like the cyber bus or something like that. But anyway, it would be taking place of like city public type transit, which by the way, for co-living, a lot of this could be huge. Not even kidding. There will be a reduced need for cars, like as more robo taxis come online. Like even my wife saw a robo taxi in Colorado Springs the other day. So like they're starting to get around. But anyway, the robo bus or whatever it's called, you like sit around and there's tables in there and all that kind of stuff.
Gotcha. Okay.
But
we are talking anyway. All that to say, welcome to the Co-Living Show. My name is Craig Curelop.
My name is Miller McSwain.
And we've got a little bit of a different episode for you today. You guys probably already know Dave Edwards. He is like the other master operator. We call him the other master operator because Miller is the main one. I think we've established this already, right?
Yeah. I'm capital O operator. Dave is lowercase o.
Lowercase o operator, yeah. Maybe even silent O operator. So he's just actually like parator.
Oh my goodness, Craig. I love that.
Look at that. I'm like hyping up Miller and smack talking Dave before he can even defend himself. So that's why we're doing this now here and then before the episode. But yeah, man, it's honest. In all seriousness, though, I think these Miller and Dave are probably the best two operators that I know in the space. So getting them both here in the same time in the same place it's pure gold. And we're talking today about arbitrage. So if you're newer and you want to scale quickly, arbitrage is a way to get into co-living without as big of an expense, without needing a mortgage, without needing to be pre-qualified, without needing to raise a couple $100,000. It is a way to scale quicker and to scale the operations quicker and it also is a great stepping stone into eventual ownership as well. And we get into all of this stuff in terms of this episode is all deep dive into arbitrage, how to acquire them, the risks behind them, how to operate them, how to structure the lease, all that kind of stuff. So if you're interested in getting properties quicker and building a bigger co-living brand and operations is what excites you, then this episode 100% is for you. Listen all the way through. Anything else we got, Miller?
Nope, I'm ready to get into it.
I guess before we get into it, we've got to say our little shtick is that we are 100% occupied in Colorado. So Denver and Colorado Springs, which is where we operate. And we've got more tenants than rooms, which is the problem that we've been praying for. And now we need the opposite, where we need to add more rooms. So if you've got a property or you're looking to buy a property and you want to get into co-living and you want to make it totally turnkey, not have to worry about all the operations and the setting it up and all that kind of stuff, we've got the solution for you. Just reach out to us over on Instagram through my Instagram, Craig Curelop, and we'll get things going if it makes sense for both of us. And so with that being said, let's bring in Dave Edwards onto the episode. Dave Edwards, welcome to the show, my friend. How are you doing today?
I am doing fantastic. How are you doing, Officer Curelop?
I am good, and you are under arrest. Whatever you say on this episode can and will be held against you, and just be ready, because I'm watching out. It's being recorded.
Let's go with a buxom 24-year-old redhead we're gonna hold something against me.
Booked a 24-year-old redhead. Is that an inappropriate line? I like
Within the first 10 seconds of the episode. Let's go.
my brain is saying I feel like that should be inappropriate, but then I like don't quite get it. So maybe
You want to start over again?
No, it's all good. It's all good. Unless you want to start
All
over.
right,
Do you want to
perfect.
start over?
We could absolutely start over. This is pretty good.
Okay. We're gonna go for it.
All right, we have not derailed the initial 10 seconds of this conversation at all. We're good to go.
We're gonna go. All right, Mr. Dave, we want to talk to you today about co-living arbitrage because you're the man, the myth, and the legend on the arbitrage side. And we've got a lot of listeners that are asking about it just as a way to kind of get in and scale up without actually having to buy something yourself. And so tell us a little bit about your background and how you got into real estate, how you got into co-living, and kind of what led you to discover co-living arbitrage.
Okay. So I got into co-living after my first house was turned into a strip club. You probably had a couple of busts at various strip clubs around the country. So you understand what I'm talking about. But turned my first house into a strip club, decided, all right, this did not work as a regular single family rental type game. Got into co-living because I wanted to make sure I had access to the house pretty much any time. That was back in 2021. And here we are 5-6 years later. Today I own 5 properties. I manage across the nation now with co-living operations. I have the largest Facebook group for co-living operations on the planet, and therefore probably the universe, unless there's other planets that have it, with over 8,500 people currently. It's pretty awesome. Yeah.
Did you hear that, Miller? Did you hear that? Miller, he's just flexing all over you right now.
I'm a fan.
Yeah. It's all good. Yeah, my co-living community.
I'm also a published author. I mean, there's not many of us.
Yeah, my co-living community that's on Mars, by the way, is like way bigger than 8,500. So
by a per capita and a percentage of people living on the planet basis, for sure.
Yes,
yeah. Awesome, man. No, so how did you get into? There's another episode, and we'll get it linked in the show notes of where Dave talked all about the strip club. So if you want to hear about the strip club story, go back to our previous episode with Dave. But
it's a great story.
You would never turn a strip club into a co-living house, would you?
There's a lot of room. There's just not many windows.
Yeah, you definitely do need windows.
Probably a lot of like hygienic surface cleaning that you have to deal with.
Yeah. Okay. So let's scratch that.
Yeah.
But what? So you didn't arbitrage that first house though, did you?
No, I bought my first. I bought my second and third. I bought my fourth, my fifth. Yeah, they're all bought. It was between my third and fourth property that I ended up getting an arbitrage. Reason being, I couldn't find a property they wanted to rent. I had a garage full of stuff because as you're running, you tend to accumulate things. I saw some beds. They were on sale, fantastic price. So I had the beds. I already had trash cans. I had basically 3/4 of the stuff I needed to get a property running. And it was just sitting in my garage. My wife was yelling at me for having the stuff in the garage. I hopped on to HAR, which is our local MLS here in Houston, and I went for rent, and I happened to find my first arbitrage was already a 6-bedroom home.
Hey Dave, before we go too far here, can we define what arbitrage is? I feel like we all definitely know it intimately and everything, but can you talk about what it is, and can you compare it to short-term arbitrage? Because I feel like people have
it's perfect. Yeah. So an arbitrage is when you arbitrage a property.
Definition in the definition.
Yeah, very good. It's fantastic. So you have a homeowner and you rent from them with permission to then apply your business to the property. Now, if that's short term, a lot of times people will be renting apartments, or they'll be renting another single family home, and they have in their lease they're allowed to sublet, or they're allowed to run it as a business. And they simply do so. You go in there, you handle all the furnishings, you operate it, you pay your rent for the difference. Arbitrage simply means to take one thing and make more money out of it by cutting it up in one way or another, right?
So instead of buying the property and renting it out with co-living and having a mortgage, you're instead renting a property and you have a rental payment to that landlord, like just as if you live there with your family or whatever. And you're not living there though. You're renting it out using co-living. So you have a rental payment instead of a mortgage, basically.
Exactly. But there's also other financial benefits, which we'll talk into in a second. Yes, Craig.
So Dave, is this a traditional residential lease or commercial lease that you're signing?
Yep. So we had a commercial lease within the property. When we signed up, it was 3-year with an option to renew on our end, which you should generally get whenever you're running a business. That was signed initially with the LLC, but also with me as a guarantor on it, and we simply ran it from there.
Gotcha. So 3-year lease. And is there any sort of like improvements or anything that you have to make to the property?
This one, yes, we did all the door lock changes. We put in one wall to convert a sitting room into a bedroom. But other than that, it was pretty much all set up. I lucked out in that the woman that I was renting this from, she was already house hacking. So she had already converted her garage into a secondary living space with what to her was one bedroom and a living room. We just converted that living room into a bedroom. She already had another bathroom and a little kitchenette in there. So it was good. And then the main house had another 3 bedrooms initially, but we created a 4th by turning the sitting room into a 4th bedroom. So we were able to get 6 bedrooms out of this place. It was an easy sale. She'd already been house hacking. She already understood the idea of room rentals. So it was a very simple discussion with her to get into my very first arbitrage.
Amazing. And so who paid for adding that wall?
I did. It wasn't much. My contractors are cheap. I got it done. Didn't really cost anything. I was able, when you look at the numbers for an arbitrage, it can be fantastic. I signed my initial lease with her was for $14.50 a month. It went up a little bit over the following a couple of years, but at $14.50 a month for a 6-bedroom property, which included to her insurance and taxes and everything, I didn't have additional anything. It was pretty fantastic. With the $14.50, 2 bedrooms paid the mortgage. Another 1 bedroom paid most of the expenses, so the rest, the other 3 were profit.
Wow. And were they mostly filled when you took it over, or did you have to fill it?
I had to fill it. So I bought it. I not bought it. I rented it as it was, did some work to it, and then we threw up on pad split and we rented it out.
And is your 3-year lease? Sorry, I'm gonna ask all these questions because
Yeah.
I'm curious. Was your 3-year lease? Was there any rent increases baked into that, or did you have a stagnant 3-year?
So it had rent increases $100 a year for the 3 years. Came into play.
Okay.
Yep.
Yeah. So Dave, I'm just curious. It sounds really weird to sign a 3-year lease under the arbitrage model. Why would you want to sign a longer than 1-year lease, like something that's kind of weird, like longer? And why would the owner want to do that?
Yep. All right. So the reason why you want to have a longer lease is you're building a business around this property. Same thing as when you own one. With the furnishing costs and a little bit of work that we did, I broke even year 1, 100% return year 1. If I didn't have year 2 and year 3 baked in, there's no profit. It was an exercise in spending my own money for no reason, right? So it was year 1, get your money back. Year 2, year 3, make the profit, right? Funny thing is, end of year 3, I actually sold off the arbitrage to another partner of mine at the time. She took that over. I made another $10,000 on top of it that I put towards something for the family. So it was like I built it up, got that, and then I was able to sell off that arbitrage.
So you sold the lease, you sold the contract with your current landlord, and she took over the arbitrage.
Correct.
And how did you price that?
Cool. I was just like, I could really use another $10,000 right now. And I'll give you the lease.
Okay. So super formulaic, and there's definitely like
very a lot of numbers floating around. That's how that worked out.
Wow, that's amazing. And so now, imagine if you had a business. I guess like where do you see some of the risks in the arbitrage model? Was there ever, or is there ever a time where like you got to make the payments, but like you don't got the rooms filled or whatever?
Yep. Miller had a 2-part question. Why would I want a 3-year lease? That was so that I can run the business and make sure there's going to be profit. The reason why the landlord wants a 3-year lease is they don't have to worry about anything for 3 years, and then 4 years, and then 5 years when it's renewed. They're not worrying. They have rent increases baked into it. It's fine. As far as risk that you're asking about, right? You get in there, you have some risk, what happens? So we learned the hard way during COVID, always have an out clause, right? There are plenty of people that were in Airbnb arbitrages, which is a similar thing, and then Airbnb shut everything down. People lost their shirts. They had no out clause with their arbitrages. So they're stuck paying the rental payments on these properties that they can't make money off of from that. At the time, I was listening to Bigger Pockets very heavily. I haven't listened to them, I don't know, since Miller came out with his book.
When I tanked the whole brand.
He did. Yeah, we were hearing all about this. Like People were stuck in it, a lot of issues. I think there was even a couple of podcasts about it, right? So we made sure that we add into our lease agreement an out clause, right? So for 2 months rent payments, we can exit for any reason, right? So it's all right. I just give you $2,800. We can terminate the agreement and walk away. So that was built in. Now that did not kick in until after year one. So I was locked into it for at least year one, and then after that, the out clause was in there.
This could be different for commercial leases versus residential, but like I know on the residential side in Colorado, at any point in time, you can break a lease if you pay 2 months of rent. So like that's like law. So that would supersede anything in any lease. And so check your state like landlord tenant laws too and see what's up there. But if you do sign a commercial lease, I believe commercial leases are going to be a little less like tenant friendly just because they don't have to be.
Yeah. So Dave, real quick, I do want to talk about the analysis a little bit and then jump back maybe to like how to find these properties and like how to talk to these owners. But just so that people know kind of the power of arbitrage, it really is the enhanced, probably much enhanced cash flow, but you lose out on other returns of real estate like appreciation, like tax benefits, like loan pay down. So whenever we think about buying co-living versus arbitraging co-living, we talked about the rent and mortgage. Those are two different. You swap those out in your analysis basically. Now you're paying rent instead of paying mortgage. So let's talk about that one for a sec. Dave, in your area, how much do you think it would be to rent whatever house would be good for arbitrage? And then what do you think your mortgage would be if you bought it today's prices, today's interest rates?
Yep. So today we're seeing rents generally slightly depressed, a little bit lower than what mortgages are. My wife, she has a single family home that she rents out long term, and today she's just breaking even with her mortgage payment based on the rents. And the tenant she had prior, she was actually losing $100 a month. She just didn't want to be losing out on $2,000 a month, so she got what she could get. And that's a house that she has is very common. It's about 2,000 square foot. Right now, it's 4 bedrooms. I already have plans to turn to an 8 bedroom. It wasn't in a pain in the butt HOA, but I walked. I was like bedroom.
Yeah. So if an investor came in and bought it, what would their mortgage be? And then like what would she rent it for to a long-term tenant?
Right. So the mortgage today would be about $2,500, whereas she's got rented out today for $2,100. If you were to get it now, her mortgage is lower than what it would normally be because she put more down. She bought it with her mom, so it's not the standard 20% down mortgage, right? So in general, you'd be more expensive for the mortgage payment than it is today for the rent.
Yeah. And it's a similar thing in our market too. Like whenever I think about some of our houses, I think they would probably rent for $2,400 a month or so. And yet PI, part of our mortgage payment, the principal and interest, is like $3,200. We're getting $600 to $1,000 spread probably just by paying a rental payment instead of a mortgage payment. And in your market, it's smaller on smaller priced homes, but still $300 or $400 difference maybe.
Yep. Now, the second part of the price discussion is insurance. Now, we tell the homeowners when we arbitrage, you should make sure you have proper insurance that's going to cover this. Do they always do so? Not generally, but we feel like we did our moral ethical obligation. We inform them, hey, we're going to be running this property, we're going to be subleasing it, make sure your insurance allows for that. But that's a very heavy expense. It can be $3,000, $4,000 a year in the Houston market. And it's certainly going to differ market by market, a lot cheaper in Arizona, for example. But that's another expense that you're not dealing with. We do pay for renter's insurance, but the renter's insurance, we're just doing that to check a box. No renter's insurance that I've found thus far for us will cover anything if we ever actually have a problem. So it's not really going to do much. On the other hand, I've got maybe $9,000 worth of stuff in the house. So it would be worth the deductible anyway to worry about it.
Hey guys, the tool I've been talking about forever, Co-Living Pro, is now officially live. So some of the biggest problems that I've encountered around co-living are always on the marketing side. So you can think of Co-Living Pro as a marketing software or a tool to help you overcome some of these marketing issues that we all run into in the co-living space. So number one, it helps you determine what to price your room at and then how to change that price over time. And that's actually a free tool. You can go there to colivingpro.io, and there's a little like rentometer type tool where you can punch in an address, punch in a zip, punch in a city, and kind of see what rooms might rent for there. But it does that for you. And number two, historically, for us to keep our rooms operating at full capacity, especially when we're off a pad split, it's meant that we had to post on Zillow, post on Zumper, post on apartments, post on Roomies, post on all these places. And with just a 5-bedroom house, that's already 20 listings right there, which is a lot of work, a lot of time and effort. So Co-Living Pro helps you solve this. You just make your listing on this one site and it pushes it to Zillow, pushes it to Zumper, and we even support any platform with the manual listing manager. So you can still be on apartments, still be on Roomies, still be on pad splits, still be on anything. And it's kind of a wizard that helps you stay organized, your VA stay organized. It shows you what rooms need to be posted where with just quick copy paste prompts. Copy your rent over, copy your description over, boom, you're good to go. And number three, historically, now that you're on all these sites, we always had to hop in daily or at least weekly to keep these listings up at the top, keep the pricing up to date. So Co-Living Pro solves that for you too. It's making those adjustments for you on a daily basis, even an hourly basis, to make sure your listings are updated across your platforms. So you guys know everything I've always done has been free. The community is free. This podcast is free. I'm super proud of that and definitely going to keep doing all that. But this tool is paid, but I feel comfortable doing that because the numbers are honestly pretty insane. So if you go to Co-Living Pro, there is a calculator where you can do this for your own situation. But let's take that example earlier of the 1 5-bedroom property. From that, we estimate you'll make an extra $1,400 a year in extra rent and reduced vacancy. And that is 5x what the tool costs. Let me say that again. This tool produces 5x the return of what it costs. So in this example, that's actually a better return than most co-living properties themselves, being around 15, 16%. So seriously, to me, this is a no-brainer. So head over to colivingpro.io. This is the tool that I built for my own business, and I'm so happy that I can finally share it with you guys. And back to the episode. Yeah. So with the insurance topic, so $3,000 to $4,000 a year or so that you're now saving again, and that number is actually similar to our market too. So that's like another $300 a month or so that is now cash flow. In addition to the, depending on your market, 500 to 1,000 or whatever on the mortgage. Now another 300 is stacked on top of that in cash flow.
Correct.
So are there any other expenses that are now different in the arbitrage world?
Oh God, yes. Okay. So if you own a property, you're in charge of the house. You have the expenses. You've got the roof, the foundation work, everything. So when we're signing an arbitrage lease, there's a lot of benefits. Listen, we're going to come in, we're going to pay you the rent that you want. We're going to fix the house up if there's any issues. Like this house, I repainted the entire thing as well. So we put up a wall. We also repainted. I had a patch. It wasn't renting out, which is the reason why it was still on HAR. When I looked at it, it had been on HAR for 3 or 4 months because she wanted a little bit more than what you could get in the neighborhood, but also the house. She just didn't have the money to do a good make ready, right? So it looked dingy. And that's a fantastic target for you to be looking at if you're looking at doing arbitrages. Look for the homes that have bad landlords. They didn't save the money up. They don't have it set up. They can't do a make ready. And just offer them, hey, I'll come in. It's going to cost you a couple $100, $1,000, whatever. I'll do the make ready. I'll get it looking good. I'm going to put up a couple of extra walls. I'll take them down when the lease is over. But I'm going to give you we're going to do a 3-year lease so you don't worry about it, right? You got nothing to worry about. But you're trying to target that. So if you just went into your local MLS, just filter by rental, max bedrooms, max length of time that's been on market, perfect target audience for you to be giving a call to.
And what's your method of reaching out? Is it a call? Is it an email? And how does that conversation go typically?
Absolutely has to be a phone call. If you just do an email, there's too many questions and what ifs. Whereas if I call and I'm like, hey, I see your house has been on market for a while. Why do you think that is? Oftentimes they'll go like, well, the rent's not working. People look at it. They don't like it. I just don't have the money to get it set up. I'm like, I can solve all these problems. I'm going to give you the rent you want. Hell, you're not going to have to worry about finding another tenant because I want this thing and I'll sign a contract for 3 to 5 years. Okay. Mm-hmm. And in fact, you know what? I want in that contract the right to continue. I'm telling you, I'm going to build a business around this. I'm going to be with you. You're not going to have to worry about it. We tell them we're going to fix it up. With that phone call, you can answer a lot of questions. You can put people to ease. I tell them, listen, I've been doing this at this point now for 6 years. Look at me. I've got this huge Facebook following because I know what I'm doing. I have 8,500 people, co-living operations on Facebook groups. So we've got that. You just tell them, you let them know who you are. You show them work that you've done if you have done any work before, right? The other part that we tell them is, hey, and you know that 10% you've been paying a property manager for? You don't need to worry about that. Listen, I am a property manager, or I'm going to manage it for you. I'm going to give you, to set your mind at ease, every month you're going to get photos of the property. I'm going to take care of the landscaping. I'm going to take care of the cleaning. It's going to be clean. This house is going to be cleaned more often than hell. Any house you've ever owned has ever been cleaned. It's going to be great. Quality will be there. And not only that, but I'll sweeten the pot. I'm going to cover the first $200 in repairs every month for anything. I'm never going to give you a call about a light bulb. I'm never going to give you a call about a leaky faucet. You don't have to worry about any of the stupid stuff. But to your point about other financial benefits, if it's a foundation issue, if it's a sewer issue, if it's a roof issue, that is a system or an element of the home. That's on the homeowner, as it would be for any other homeowner. But it's not on me like it is on me for my current properties to handle that. So now I'm saving those tremendous hits that can really smack you. Your $10,000, your $15,000 new roof or foundation work, you don't have to worry about that with arbitrage.
Yeah, and Dave, I just want to repeat what you just said and just confirm everything and like just to solidify the pitch. And so like you reach out to a landlord. They have a 5-bed, 3-bath house with some extra spots that is a little bit run down, and you're gonna give them a call and say, "Hey, this place isn't getting rented. Why?" They're gonna say, "Well, it's probably because it's not good enough. We don't have the money to fix it up. People have looked at it, but they don't want to move in." And you just say, "Hey, I'll take it right now as is, and I'm gonna do the paint and I'm going to make it clean. I'm going to make it look good. I'm just going to add another wall that will be taken down at the end of our lease. I'm going to sign a 5-year lease with you, and you don't have to worry about a thing for the next 5 years." And like that's the pitch. So you do pay for all that initial stuff, and that is worth your investment.
Correct. I mean, it absolutely is. It's much less than a down payment. Arbitrage is purely a cash flow play. That's what it is. Like Miller mentioned earlier, we're not seeing any of the other benefits. You do have tax write-off for all of your furniture. You do have tax write-off for other expenses. So you get that, but you're not getting the ongoing depreciation.
Okay. Cool. All right. So back to the numbers piece. Are you saving like $1,000 on rent? We're saving a lot on property insurance. We're not paying for CapEx anymore, right? So CapEx being like the roof replacement, the bigger items that we were just talking about. The landlord's still doing that, which is probably $300 a month. Boom. You get
Landlord's
to keep that now
still paying
too.
the taxes.
Okay. You're not paying taxes either. So a couple more $100 a month. Anything else, Dave? So far, that pie, depending on your market, probably adds up to an extra $1,500 a month, an extra $2,500 a month. Like it's pretty substantial.
Arbitrage can function the same as almost a 10-bedroom property that you own, as far from a cash flow perspective. So you can. It's a lot less work. You just find a 4-bedroom already with a living room being cut in half and get 2 bedrooms out of, and boom, you're off to the races.
And so, what are you doing for a security deposit with the landlord?
Yep. Security deposit is something that we can use as part of the negotiation. So I like to try to keep it at the security deposit they were asking for. I don't really bring it up. But if they're like, "Oh, you're going to be doing this work, you're going to be putting down walls. What if you disappear and it's going to cost me more to take the wall down or something," right? They can be worried about that. So we've done, and there's a couple of different ways we've done it. We just double the security deposit. Whatever. You wanted $2,000, I'll give you $4,000 security deposit. It's fine. Second element you can try to layer into that is I'm going to give you double the security deposit. After that first year, I'd like half of it back. We're showing you it's not a problem. You're happy. We built some trust up. You might not trust me now, but in about a year, I'd like to get my half my security deposit back, and we do that. Now, the other element is you should consider as well is a corporate lease, right? That's what we get into play. They're still going to want to be looking at you as a person for your background, your financial credit history. So expect them to be running you the same way they would normally run anybody else. Just as an aside.
Yeah. So Dave, when you're running these numbers, we've talked a little bit about you do have to furnish the property before you set it up and start renting it. You do have to pay security deposit, right? That's some of these things are like your initial costs, like your remodel costs, your down payment, like your closing costs, like some of your initial startup costs. So beyond remodel, so you would be doing some remodel, some furnishing, and that security deposit. Any other numbers people should be thinking about for their startup costs? And how do you actually think about using their numbers? Is there still a cash on cash return, or how can you think about these numbers and analyze them?
Yep. So your cash on cash return is going to be your total expenses that you're putting into it. So my buddy Ron, he doesn't consider furniture as part of a setup cost, because whenever it's done, it's just a fixed cost. I'm going to move it from property to property. I don't consider that part of cash on cash. I do, however. I consider everything that goes into it as a one-time expense. I'm going to recalculate it every time I do something. So you've got, like you said, the down payment that can be $200 to $400, not down payment, but security deposit $2,000 to $4,000. You're probably going to spend about $5,000 in rehab work if you're going to be adding walls, painting, moving some electrical around, which we've done. And then you're going to be spending about $800 per room. So the 6-bedroom home, 6 times 8, 4,800. So I was at all in on this property for the first arbitrage. I was in about $14,000. Okay, to get that taken care of. Now we made a little over $1,000. Some months it was $2,000 in cash flow off of that property. So I was saying my cash and cash return, 100%, a little more than 100% year one, and then after that, just infinite cash and cash return going forward because everything else that came in was gravy. And again, the arbitrage, I didn't have to worry about getting hit with that $10,000 bill for a roof or a foundation. In fact, while we were there, she did indeed have to have roof done. And that was a $3,000 expense because a tree from the neighbor's house fell on her roof. So that wasn't something that I had to worry about.
Yeah. So Dave, with the arbitrage model, or well, let me pivot it this way. So with the buying model, there's a lot of people concerned with certain co-living regulations around unrelated persons and all that kind of stuff. Let's say that you did buy a house in some area where those regulations exist. You are taking on a very large risk, I think, just because really, if you do get caught, your pants are like totally down. You've to go back to some of these strip club metaphors, and
let's do that.
and now you bought this thing with maybe $100K down, $50,000 remodel, whatever, and now you own it and you're not allowed to operate it anymore. Do you think of the risk with the arbitrage model differently? Not that it wouldn't still be illegal under certain circumstances, but if you were caught with your pants down, what do you do in the arbitrage model?
So we just covered it. If your worst case scenario, you get a house that you do all the rehab work and then you get red tagged 3 months into operation because they don't like it there. If you're here in Humble, Texas, one of my former clients, they showed up and they literally yanked the electrical meter off the house because they didn't want co-living so badly. So he had turned the house into a 14-bedroom home. So that really can go south, right? With an arbitrage, what are you out? You're out the 2 months that we have to pay for our exit clause, which honestly could probably just come from the security deposit, which you've already basically counted as an expense. Although many areas you can't, you gotta pay, and then you get your security deposit back or whatever. It's a wash. So you're getting that back. You're knocking down a wall that you just put up, but knocking down a wall and fixing the ceiling and the floor is a minimal expense, especially the way that we build walls. We build pressure walls. So if I ever have to, I just knock the stove with a hammer and it falls over because you release the pressure on it, right? And so we get that taken care of. Just your exposure is a lot less. If you're risk adverse, arbitrage, depending on the way you write your contract, can be a much well. Even if you had the worst written arbitrage of all time, it's still less risk than putting $100,000 down payment on something, another $60,000 in rehab, $20,000 in furnishings, and then being red tagged, right? Mm-hmm. It's not going to be the worst thing in the world. Arbitrage is also a great way for someone to enter a brand new market. I've been toying with the idea of Passable, right? It's one of the main company I use. I recommend them for people if there's just some guy with just some house, but if you're someone special like you guys, you built out a business in order to identify tenants, go off Passable, right? But if you're just some guy, go with them. But Passable keeps opening up new markets, and an arbitrage would be an excellent way to ride the wave. Be like, oh, you just opened up in Cincinnati. I'm going to get 3 arbitrages. Okay. 3 years later, the rents have gone down, competition's gone up. You can exit Cincinnati and go and just truck your furniture to the next city that they've got going live, right? You could ride the wave with an arbitrage and you're not necessarily being tied down somewhere, right? It's a good way to try to do that and to enter new markets without overexposing yourself.
Yep. One other question I have, and this is more of a responsibility type question, is if there is a big repair that needs to be done that the landlord would be responsible for financially, do you orchestrate that repair? So if it needs a new roof, are you going to call the roofer and get the bids and do the things so the landlord doesn't have to worry about it? Or are you just like, no, it's all you?
We don't say that we will, but we have, right? It's not written in the contract. I'm not voluntarily, preemptively taking it on. But this woman, honestly, she lives down in Argentina. And so She's been happy. She's making way more money just from this house than she would otherwise from anything down there. So she lives down there, and I just took care of it for her, being a good tenant. So she was very happy with us because we helped
Gotcha.
out. But in
So,
general, we wouldn't normally be doing so.
okay. Good to know.
Yeah, and so really what we're talking about here with arbitrage is this is like a pseudo like different acquisition strategy, right? Like this is how you get rooms into your portfolio. Dave, as the operations guy, is there anything different on the operations, or is this just a bait and switch on the how you get the rooms into your portfolio?
Yeah, the only difference between operations is just acquisition of the house and who we're paying for it, right? I guess another slight tweak is just that instead of us, for my own personal properties where I'm handling the bids for something major or whatever, we're just letting the landlord know, hey, we need a new roof.
Yeah, maybe the only other thing that I just thought of, yeah, is like the communication side of things. That was one thing that kind of surprised me when we got into third party management. I was like, oh, this would be pretty much the same as buying my own places and all that. Like when we buy with partners, honestly, our owners don't really ask too many day to day type questions. But when we're dealing with owners and we're doing like third party management, there's questions like all the time. It was like a whole new kind of arm to stand up of the business that I wasn't really ready for, I think. So how do you think about that on the arbitrage side, like the communication? How involved do these people want to be kind of on that spectrum of being super nitpicky or being never sending you a text?
So that whole, remember how I was saying when I call people up, I'm like, listen, I'm going to do a commercial lease. I'm going to send you photos all the time. We're going to let you know what's going on. I say that just to make them comfort. I don't think she's ever looked at any of them. The entire 3 years, I don't think she ever, that I had it before I sold off this one, I don't think she ever looked at it. Other clients, other arbitrages that we've done, they've looked at it a couple times. One guy was like, oh, what's that smudge on the wall? And I found out someone had just gotten it dirty with their work uniform. And we're like, we'll clean it up. Don't worry about it. It's fine. It's not damage or anything. It's just soot from the guy's clothes. So they look at them a little bit on occasion, the photos that we provide, but it's nowhere near the amount of communication that I have with the 60 some odd owners that I manage for.
Interesting. Do you feel like there's a proper balance of manage a certain amount of rooms versus arbitrage a certain amount of rooms to just like kind of keep your risk low, or are you all in on one or the other?
By Matt, are you saying like own a certain number and arbitrage a certain amount? Or are you talking about me with my management?
Yeah, I'm saying like own. I mean, I guess yeah. I guess own a certain amount, manage, take a percentage of the rent, a certain amount, and then also arbitrage a certain amount. Is there a mix that makes sense from like an overall portfolio that you manage perspective?
Okay. I don't think there's a mix per se. Everything is treated as its own silo. Everything operates itself, right? The arbitrages are there. They're in their silo, the business silo. They make money. My management team oversees the operations of those. I'm paying myself. Honestly, I'm swapping some cash between the two companies. That's fine. And then just the ones that I own. Myself personally, I've taken a beat on acquisition right now while I work out new build. But yeah, I don't think there's an exact mix or anything.
One more thing.
Yep.
Is there any sort of, when you're renting a place and it maybe takes a month or so to get it set up and all that, and maybe another month to get it filled, is there any sort of delayed like rent or anything that you do where it's like, hey, we'll start this?
We have done that. Exactly. So we've negotiated first 2 months rent free because we're like, especially if the house is really beat up. Like we've done some where the house was like, there's like holes in the wall. And we're like, listen, we're going to need to do this. We're going to add another bathroom. These are some of the bigger projects where we turned arbitrage 4-bedroom into a 10-bedroom home. We've done a couple of those. And with those, we have the homeowner saying they don't want us to knock things down later. They're gonna go through later and be like, oh, what do we want to knock down? But for all with that major expense, that's a $30,000. The most expensive arbitrage makeover that we've had so far is $35,000. We converted a garage. We put in another 2 bathrooms. We fixed some plumbing, some other things. Repainted the whole house. Redid some flooring. Added ceiling fans. Quite a bit of rehab. But for that, we got a 5-year lease and the first 4 months actually for that one rent free to go through the full, just for the time on the rehab.
Okay.
Yeah, so I think that's really good.
You can negotiate all of that. The homeowner's getting a lot of benefit. He's getting this house that was a shithole that no one was renting from him anyway. It's getting fixed up. Bathrooms are being added, so there's CapEx. Everything's being done, and they're going to end up with a better property 5 years from now than what they started off with.
Yeah. So yeah, I think that's really important to think about how much rent discount or forgiveness do you get on the front end? Because kind of how I've been thinking about doing the numbers on this. So Craig and I don't have any arbitrages, but we just kind of been like talking about it a little bit. And I think about it as payback period. We talked about cash on cash. Dave, you kind of mentioned the payback period earlier too. If you're adding these furnishings, adding these walls, and now you're paying rent and you're doing all of this, like how quickly do you get your money back? If you got a 4-month discount or a 4-month free ride on the rent, even though this was a $35,000 remodel or whatever, if you start getting that place filled up, you might get your payback period might really reduce with that.
Yes.
Reduced kind
we
of.
ended up we had 4 months rent free, but it only took us 2 months to get it up and running. So then we had 2 months of renting and making cash.
Awesome. Well, cool. Hey, Dave, before we close this out, last question. So for listeners out there, this might be the first time they've heard of arbitrage, or they probably mostly hear about buying and maybe they hear about arbitrage sprinkled in there every once in a while. What sort of questions should people ask themselves, and like who is buying better for and who is arbitrage better for?
Yep. So arbitrage, if you're looking at dipping your toe into co-living itself, you don't want to put all of your capital at risk with it, it's great. If your primary goal is cash flow, so you're trying to get to, you could do 4 or 5 arbitrages for the cost of 1 down payment and remodel. If you're looking at acquisitions, so you could be looking at $5,000-$6,000 in cash flow for the same amount of money that you would put down to get maybe $1,000-$2,000 in cash flow if you were to be buying a property and rehabbing it to the nines, right? So you can certainly be a stronger cash flow play that you're looking for. I've got one buddy, he has 20 some odd properties under arbitrage right now. And he's bringing in over $100,000 a month in rents on these. So it's fantastic. He hasn't put down that much for acquisition, so he's getting that in. So again, if you're dipping your toes in co-living, if you want to maximize your cash flow, now keep in mind it's going to be something you're going to be cycling. It gives you cash flow for 5 years. You got to be saving enough down for the next 5-year cycle. But that's why you have in your lease agreement your right to extend, right? Also remember, even if that homeowner sells that property, your lease goes through. So your risk is not there. They could sell the house off to another investor if they wanted to. You're not losing your hard-earned cash and expenses. Yep.
So that actually perfectly leads into the question that I wanted to ask is, number one, you actually increase the value of their home because your rent is higher. And if they're trading to another investor, they're going to trade on cap rate. And if you're giving them above average rent, and that's fully occupied, and you're covering $200 a month of expenses, like their NOI is going to be higher. And so that's going to therefore increase the value of their property. Dave, I did want to ask you a question though. Do you believe that like arbitrage is kind of the stepping stone for ownership? Would you have the right of first refusal so that like in your leases, so that if they did want to sell, you would be the first person that they would have to go to?
We do have that in some of the properties. We added that about midway through. Hey, wait, this is stupid. We should make sure that we have a right towards it. So we added that. It wasn't standard, but yeah, absolutely something that, if you get that in there, you can get them to allow for it. Absolutely. Get that.
And I will say that if you can build trust for 3 to 5 years with an owner, and let's say they've got a property that has a 3% interest rate, and you've been paying them consistently for 4 to 5 years, keeping great use of their property, you're poised to get like a subject to or do some creative type deal with them.
You're absolutely poised to get a seller finance where if they have a 3%, you pay them 5% or something.
Yeah, the arbitrage is you're warming the oven, right? You're getting them, for lack of a better word, it's the foreplay, getting them ready to sell to you. We're started off.
I can't wait to see the title of this episode.
You look like a stripper cop.
We're gonna have to have one of them E's at the bottom right of our corner. Like the 2000s like rap albums. Yeah. All right. So yeah, this is Dave. This has been a really awesome episode, and I think it's shed a light on it transforms the business model.
I love how you guys do episodes on whatever it is you're thinking about doing yourselves, just to get some information from people before you.
100%. You figured us out.
I understand what you're doing. Yeah.
You know what I want to see?
I could use Claude, or I could just interview somebody. Let's go.
And then we could throw this interview through Claude and then have it parse out what's good. But I was like, I was realizing I'm like sitting here looking at you baldies on the call, and I was like, I feel like if co-living was a video game like Tekken, this would be like the world. This would be like the operator championship that I would be like watching here, like the Miller versus Dave.
We're pretty similar in
So,
a lot of ways. The ways that we do things. It's just that mine
oh,
are
for
better.
sure.
Yeah, we could never be business partners, that's for sure. We do all the same stuff, but me and Dave really enjoy hanging out together, so that works.
That's
Did you
good.
guys
Yeah,
see
do you guys
my
like
magazine?
your
Did you see
magazine?
the co-living edit? Oh yeah, it's awesome. So episode 1 of the co-living edit is just all the furniture recommendations, and then episodes 2 is going to be like how to take this furniture and build systems out of it, like systems that work. And then I want to do a tech episode at some point, or issue at some point. It's gonna be pretty cool.
Yeah, you got to bring me in. I'll write an article.
Yeah, it'll be good times. I used this shit out of Claude to build it. That's why
I was gonna say, there's no way you guys are actually writing articles. Zero chance.
Oh, no, but I just made it towards everything that I've ever said or written, and it basically
It spits out like a yeah. Awesome. All right, Dave. We were thinking about doing the big 3 with you, but we just did it a couple months ago. So I think we're gonna skip it. But Miller does have a crazy funny question to ask you.
Oh God! Good thing I can think
you
of
remember.
things on the spot. Let's see, Dave. When's the last time you tried hair supplements or Rogaine, or because I do see you're growing on the sides now?
Oh wow!
Yeah, it's coming back. How are you doing this?
I've just been away from my trimmer. We've been on a couple of trips. I spent 3 weeks in your neck of the woods. We went all over Colorado. We went to Colorado Springs and then Denver, and then we went to the Rocky Mountain National Park, and then Estes up there, and almost got kicked in the head by caribou or whatever. And then that was fun. And then let me pet you, fuzzy. And then we drove through the mountains to Steamboat, and we were up like 11,000 feet. My kids got to play with snow. They haven't seen snow in years, so they got to play with snow up there. And then we were in Steamboat, and then we came down, and we found this one. Oh, this awesome place. It's a winery / strawberry farm or something, and it's just built on a slope, and they had these swings for the kids. If my kid jumped off of it, he would have fallen like 70 feet. So
I missed the segue there. Did someone give you Bosley free samples or what?
No. Oh yeah, segue. I was just gone. I couldn't trim my hair because I was having so much fun. Yeah.
Did you know that there's barbers in Colorado? I think. But you were too
think my wife would let me spend money on a barber? That's ridiculous. I have a $12 hair trimmer from Walmart 6 years ago, and it still works fine. Damn it!
It still works. They also have Walmarts in Colorado too, but you didn't want to spend extra $12, did you?
I'd have to spend money like going out of my way because it would be on the other side of the street, and I'd have to spend gas money. It would be upsetting.
Yeah, I get it. It's not worth it. Yeah,
It's not worth it at all. It's okay.
All right, Dave.
I've been trying to grow my beard out. My beard is really coming in.
Can you get closer to them? There we go. He's getting a little closer.
It's been 7 months since I touched it. It's doing good.
You should try to grow the stash out, and then you could be like me. It could be like a combination of me.
I've just been rubbing manure all over my face because I think it would help it grow.
It does. It is. Yeah. It works just like plants for sure. Yeah. It does. Awesome, Dave. Hey, thank you so much for taking the time, man. And just like unlocking. I feel like arbitrage is not talked about enough or even at all in this world. And so I think you've banged on for some people.
It's like they're like, why would anyone do it? Is the problem. They're like, why would someone rent a house to me? Again, the best ones to rent out to you are the people that are desperate. They've been sitting on a house for making their own rent payments for 4 or 5 months now. They don't have the money to do the make ready to actually rent it out. If they rent it out to a regular person in many markets, they're not covering the full nut to get their mortgage payment, right? You're looking for that accidental landlord or the guy that just gave up or whatever. And that's who you want.
Yeah. Yeah. If you do this right, you are providing real value to the marketplace. That guy wasn't renting his house. Now he is. So, all right, Dave, let's close this out. Where can listeners find more about you, connect with you, and chat with you more?
All right, it's going to be a while. All right, so on Facebook, you go to the groups, look for co-living operations. Again, it's the largest. There's 8,500 plus people in there. There is a school. If you go to skool.com and you search for co-living operations there as well. I've got free school, you got some stuff there, and then you got the premium where you get to spend 1 to 5 hours with me every Wednesday if you're part of that group, just because we just keep going until there's no more questions. I've got the YouTube, so again, co-living operations, if you look for me on YouTube, and then you can go to my website, colivingoperations.com, to talk to me about property management, read the magazine, see our recommended furnishing items, a couple other goodies there as well.
Yep. Yeah. At the very least, you guys should go look at Dave's furnishing list. We actually rely on it pretty heavily. So well put together, Dave.
Thank you.
All right. Well, cool. All right, let's get out of here. Thanks so much for hopping on, Dave. And love you. Talk to you soon.
Talk soon.
See you guys.
Peace.
See you, Dave.
Bye.
All right, so that was Dave Edwards. Miller, you ready to pick up some arbitrages now?
Definitely ready to read more into the episode. Yeah, so I think that honestly, we learned a ton on this episode. Arbitrage isn't something that Craig and I know a lot about. I've never done it. I don't think Craig's really done it. So I really enjoyed bringing Dave in here because there is a lot to think about. The expenses, totally different. The income's the same. There are a lot of difference with it, expense-wise, risk-wise, even how you find the properties, right? This is like a whole different funnel that you would set up. You're not scrolling Zillow on the buy page. You're scrolling it on a different page now. So anyway, I'm super excited to have all this info and start thinking through it, but that's kind of how I work. So
yeah, I'm fairly excited about it, mainly because I don't think you need an 8 to 10 bedroom house to make the numbers work. I think we could rent out a 5 or 6 bedroom house. And I'm just thinking about in Denver, for example, like a 5 bedroom house might rent out for like $2,800. But if we can average $800 to $900 a room for a 5 or turn it into a 6 bedroom house, we could potentially get close to $4 or $5 grand in rent, paying $2,800 a month. And so that's pushing over $1,000 a month of arbitrage. I feel like that is probably worthwhile.
So yeah, that is a good point, even from the marketing side. Yeah, if you do all this work and you're getting on paper, it looks like the same cash flow in a buy and an arbitrage, you really might just stay more full and more occupied and actually might have higher cash flow on the arbitrage side because you have less rooms to fill. And when you're advertising them, oh, this is room number 5 or room number 6, and it doesn't go above that. So yeah, there could be some marketing advantages there for sure.
Mm-hmm, mm-hmm. So yeah, we'll have to just see. I think it's definitely worth a test. I think we should probably run a couple of them and see how they go. I'm still a little nervous just about the obligation, even though you can get out with like the 2 lease, just paying 2 months worth of the contract or whatever. If you multiply that by 100 leases at 4,000, you could be talking $500,000 if your whole portfolio is that way. So
yeah, like I really don't want to undersell the risk. Like there definitely are risks associated with this. Whenever we talked with Harrison Damara, I don't know, I think it was like episode like 1 through 5. He was like pretty early on, but he was part of, what was it, Common, and there's been some other larger co-living companies over the last 5 or 10 years that have used this arbitrage model, like on very large apartments, renting out the whole thing and then re-renting all the rooms out. And so far, all those companies have busted. So there definitely are risks to consider, but I think the biggest one is Dave talked about having the protection clause in there so that you can get out, because I think that was the risk, Craig. They quit renting rooms, but they still had the rent payment was the deal.
Mm-hmm. Exactly.
Like
so I think I think having that clause in there is important, and also I just think having like a hefty, like a mix of percentage, like traditional management as well as arbitrage, just to, again, I do believe because the operation is the same, having different structures does not change the operation, but it does alleviate some of the risk in it. So yeah, but overall, great episode. I love having Dave on here. He's just like a funny dude, and he's always fun. The banter is always good with him, and he just knows so much. Yeah, just make sure you go follow Dave. If you're not already in Dave's Facebook group, I feel like if you're in co-living, you're probably in Dave's Facebook group, but if you're not, go join it. Definitely a lot of good stuff happening in there. So Miller, anything else you got to say before we got to go?
Nope, that's it.
All right. This is Craig Curelop and
Miller McSwain
signing off.
See ya.